Hey everybody, it's Adam Parks with Trinity Wealth Management, once again coming to you today with Eugene Choi, who is the Regional Director for Dunham and Associates. And the reason that I brought Eugene on the call today is because he's got some really terrific strategies pertaining to tax mitigation and how we can help you with your tax situations when some very unique situations arise. So thank you for being on the call here today, Eugene.
Hi, Adam. How are you?
Very good, very good. So
Yeah.
Eugene, you and I met a few weeks ago back when I was first introduced to Dunham and Associates, and we had met and we were talking about some strategies for taxes and clients that have highly appreciated assets. And as people know, when you buy it for low and you sell it for high, sometimes those taxes come into play, and
Mhm.
that's it's a good thing, but it's also a massive challenge for our clients. And one of the strategies that you brought up, I wanted you to kind of jump on the call today and kind of go into because I think it's a very important thing. It's an awesome strategy for the right situation. And if you can kind of get into that, we can kind of go back and forth from there.
Sure. Awesome. Well, thanks for having me, Adam. Yeah, we've been really busy at Dunham and Associates and Dunham Trust Company and helping clients over the past 30 plus years. It just over the past year, we've found ourselves running into a situation where we've had clients with highly appreciated assets. So think real estate, think land, think businesses that they were looking to sell. Upon selling, they're hit with a huge tax bill, like you said. And so what we've come up with has been around for quite some time. It's called an intermediated installment sale trust. And what an intermediated installment sale trust does is it allows the client, through the use of IRS tax code 453, which is an installment sale, upon selling their business or real estate or any other highly appreciated asset, we can defer their capital gains tax for 20 years. During that time, they get an income stream for 20 years. And also during that time, those assets are protected, they're invested, and then they pay the final tax bill 20 years later.
Terrific. And from what I'm gathering, basically, so if I'm selling my firm and my companies, and I'm going to be getting, say, $1 million. If I was to sell in traditional terms, if you were to buy that firm from me, I have to pay capital gains on that $1 million in the year that I sell it. So, but in this situation, I can break that up over 20 equal payments and make those payments. So it kind of mitigates that one lump sum tax bill as opposed and turns into an income stream for me for those 20 years. And that way I'm paying less on a lot longer than one big chunk at a time. Is that correct?
Correct. And you can also actually, in addition to paying the taxes over the 20 years, you can do a balloon payment to not pay any of the taxes until the 20th year as well. And so there's a lot of flexibility in what you can do with this and how you can structure it. But let's go back to that $1 million example of you selling your firm. What are the taxes that you're going to owe upon selling that? You're going to owe a 20% long-term capital gains tax. You're going to owe a 3.8% Medicare tax and any state income tax if you live in a state that has state income taxes. So let's just say about 30%. So you sell your business for $1 million, $300,000 of that is going to go to the IRS for your tax bill. This intermediated installment sale trust allows you to take that $300,000 along with the full proceeds of that $1 million sale. And instead of having $700,000 to invest because you paid your tax bill, you get the full $1 million. That $300,000 tax that you would owe is deferred, invested for 20 years or up to 20 years. And then at the end of the 20-year time period, again, you can either pay as you go, or you can say, okay, it's the 20th year. Now I owe my tax bill.
Okay, terrific. And as far as some of the other benefits that I know that, well, for a situation like ours, if I was to sell my practice, maybe say to a junior advisor, a lot of times there's some hesitation there, or whatever business it may be, there's a lot of hesitation there to take on that note and have that seller held financing because I'm put at risk, as opposed to having somebody buying the practice from me paying fully into the trust, and then it's into the trust, not necessarily, and it's paid. So you don't have to worry. So, because a lot of times you'll defer those taxes or take maybe a 10-year payout on your business. And I've seen this strategy happen before, just so you're not getting killed in those taxes. Well, this is a way to get that full boat now. It's protected, and then it's in your bucket instead of in their bucket. Is that correct?
Absolutely. And so Dunham Trust Company, serving as the trustee of that trust, we're based in Nevada, but doing the strategy that we're speaking about right now, it reduces the risk of you in selling your business of carrying a note for the buyer. If you sell your firm to Bob down the street and Bob bankrupts your business, but he's agreed and you guys have both agreed that he would pay you over a course of 10 years or whatever it is, he doesn't have any more money to pay you because he bankrupted the business.
Right.
Whereas if we do this intermediated installment sale and him financing that purchase, all of those assets get placed into the trust. And the second they get placed into the trust, you don't care what happens anymore, or you don't need to, because the assets are now completely protected, even if Bob were to ruin your business or get bankrupt and not be able to pay you off.
Got it. And speaking of protections, I understand that it's also creditor protected, correct?
Correct. So our trust company is based in Nevada. Nevada has, out of the 50 states out there, the absolute strongest asset protection laws in the entire country. And so in addition to any creditors that could come after you, Nevada is one of only 2 states in the entire country that also protects against divorcing spouses. And so divorcing spouses in most other states, 48 of them, have access to trust assets in terms of alimony and child support. And in Nevada, where our trust company is located, completely locked.
Okay. And what if tax changes? There's some tax, because obviously today's the day after a big election, presidential election. We still don't know who wins, but in these new administrations or in these new Congresses that are going to be coming in the next however many years, in our lifetime anyway, what happens when tax changes occur? Is this affected?
Yeah, so we at Dunham Trust Company would be serving as trustees on that trust, with the person who's selling their business would be the beneficiary of that trust. And so we're always looking at a myriad of reasons as to why we want to either decide to continue to defer the taxes or if we want to pay everything out. And so let's assume that tax rates change. Let's say that capital gains rate completely goes away. The Tax Job Cut Act is going to sunset in 2025 anyways. And so as tax rates increase, when they do, we as trustee are going to follow the prudent man rule and basically say, does it make sense for Adam to continue to defer these taxes? Because we signed a 20-year note and here we are in year 5. And so he has 15 years left, but tax rates are going to be much higher. Does it make sense to continue to do that? Or should we just close out the trust right now and distribute out everything? And so we can make that decision, and that's that's part of our fee as trustee and managing that trust, is to do things in a very tax efficient manner.
And what a lot of us know too, or hopefully should know anyway, is that taxes are decided and then implemented later. So you do have time to make those strategy changes as needed.
Correct.
And the other thing is, if I needed to take money out of the trust in advance, we're not locking into a 20-year payout. If I, like you said, you could defer taxes to the end, or if I wanted to take a big chunk in 5 years to buy a kid a house, or I wouldn't do that, but you got to work for that house. But so that it gives you some flexibility in when you can take those dollars out as well.
Correct. There are some guardrails on it, but a lot of people think that once it's in a trust, because this is an irrevocable trust, and people don't like the word irrevocable because it means you can't change your mind. And so going back to that $1 million example, let's say it's placed into the trust, there are multiple ways that you can get income from it. For instance, HEMS, so health, education, maintenance, and support. Now, if you came to us and said, hey, we signed a 20-year note, and you come to us, Adam, and after 5 years you say, I need $400,000 out of the trust because I want to buy a boat, we're going to say no, because then the IRS is going to come back and, yeah, sorry about that. Then the IRS is going to say, okay, then this whole thing wasn't set up properly. You were just trying to avoid taxes. You now owe interest and penalties. But for health, education, maintenance, and support, for other reasons that are plentiful, we would gladly distribute out more than what the income is already paying if the client needs that. So yeah, there's a lot of flexibility in you being able to take out more than what you're receiving already.
And then once they were to do this, so say I have John Smith and he's selling his business and he's going to come into this large sum of money and he does this, who's the actual trustee in this case and who would the main point of contact be?
So Dunham Trust Company would be the trustee on that trust. That goes a little bit more into our story of our trust company in general. The main contact would be you as the financial advisor. We do have trust officers across the country that fly and meet with the clients. But one of the things that we want to do at Dunham Trust Company, the reason why we were created, was for the financial advisor. And so the client has direct contact with you as the advisor. You're the one managing the assets. We also have an investment firm, but by no means is the client required to use our investments in order to use our trust services.
Okay, great. And if you don't need to put everything into the trust at one time, you want to have that big payout as you retire. It's not like you have to take all of the proceeds from the sale of that particular asset and move it in there. You can separate that, right?
Correct. So let's just think a little bit bigger, and let's say a business is selling for 5 million or 10 million. If I'm selling my landscape business for $5 million, but I want to spend $1 million or $2 million for myself to pay off some other debts, to travel, to buy stuff, to gift. You're more than welcome to do that. You can do a partial installment sale. And so on the $5 million sale, if you want to keep $2 million for yourself, you're just going to pay the taxes on the $2 million. And then the $3 million can go into the trust, and then you can defer the $3 million.
Okay. And I know we kind of focused really because more of a closed situation where it's present situation, so it makes sense, but on business owners, but it's not just businesses, it's real estate. It's, as you said, highly appreciated art, raw land. What are any other kind of
business interests? There's any highly appreciated asset outside of publicly traded stock.
Okay. Yeah, that's one thing I was really excited about for a minute there when you said you could defer the.
Yeah, we haven't found a way to do that yet, other than through the means of if you're charitably inclined, we can do a charitable remainder trust and some other options to give you an income stream while not paying taxes on that. But
so you're working on it then, right?
We're working on it.
Okay, good.
We haven't found a way yet. But this is a really good alternative for clients who have a business or have real estate. They might be familiar with things like 1031 exchanges or opportunity zones. In my experience, and if I was 60 years old and I had a business that I poured my blood, sweat, and tears into, and I wanted to sell it, but I didn't want to pay the taxes, I don't want to replace my business for another business or my property for another property. I just want to be done. Right. And so this is an alternative that completely gets rid of that property. You now get an income stream from that property that you've sold. You've deferred the taxes, and you actually have the opportunity to, in the money that you've deferred, have that actually grow throughout the 20 years as well.
Yeah, that's an important piece for the investment side of it too. That's really exciting. So instead of taking that, use it $1 million example and breaking off $300,000 and losing any growth potential, only having the 700 left, you retain the full $1 million for a growth potential for another 20 years.
Correct. Really and you have inflation working to your advantage as well, because that tax that you owe 20 years later is going to be based on, let's say tax rates don't change or they go back to where they were. You're going to be paying the tax rates 20 years from now, but based off of $2020. And so you get 67 cents on the dollar, and you have inflation working to your advantage as you defer that money as well.
Right. I think it's a fantastic strategy, which is why I wanted to bring you in on the call and kind of record this so our clients and advisors can kind of put this in their quiver as a solution and a strategy for their clients. So again, just as a summary, if you've got a highly appreciated asset, real estate, business, art, land, whatever, just not a securities at this, not yet. Consider the intermediated installment sale. Got it. That's
got it.
Okay, good. And because this could then stretch your tax liability over 20 years. The income stream is capital gains, so it's not ordinary income, so it's at a lower tax rate. It's creditor protected, and it's also protected from the actual sale, so you don't have to work on a different kind of a seller finance strategy and put yourself and the money and the equity in the business at risk should something go wrong with the business after the sale.
Correct. There is actually, depending on how you structure it, it could actually be ordinary income, because what this is essentially doing is replacing the income that you lost upon selling your business or your rental property. But there's, again, I would say if you have, and you're thinking about selling your business or you're thinking about selling your real estate, the perfect time to start talking about this type of strategy would be as you're thinking about selling it. Or if you already have an interested buyer, if there's already a letter of intent signed, if there's already a contract signed, we're really in like the 10th inning where it could really end at any point. If you sold your business and the money is sitting in your bank account, it's too late. And so the time to be talking about this type of stuff would be that as you're entertaining buyers, as you're saying, okay, I'm ready to sell my business. Nothing changes from the buyer's perspective. So right. If you're worried and saying, well, if I do this, then my buyer might not buy, there's no different from the buyer. It's the same exact terms that you had with the buyer. The only difference is that the buyer, instead of writing you a check to John Smith, they write a check to Dunham Trust Company.
Great. Well, Eugene, thanks again for being on the call. I really appreciate this. If you have any additional information, obviously we love the developments as they come. And clients, if you or potential clients, if this sounds like something that you'd like to entertain, some strategies, we can jump on the phone with Eugene and do a joint call and kind of go over it a little bit better, a little bit deeper detail. But yeah, man, Eugene, thanks so much. I know you're really busy today. Thank you for being with us today, and I'll definitely be in touch.
My pleasure, Adam. Thanks for having me. Appreciate it.